Welcome to Mindset Wealth's 18th annual Look Ahead Conference. Today is February 12th, 2025. To what's going to go on, my name is Robert Mulrooney, Senior Investment Advisor with IA Private Wealth and founder of Mindset Wealth. We like to do these events for our clients, educate and motivate. What's going to happen is I introduce the team, Russ Waggle from his home in Comox Valley, Rudy Chung, downtown Vancouver, and we have a special guest. We've had economists, we've had product specialists, but it's the first time, I think, in 18 years we've had an actual portfolio manager, so we're super excited. I can turn it over to Russ Waggle, and he'll introduce Dan.
Thanks very much, Rob. Yeah, today we have Dan Batastic with us. He's a Senior VP and Investment Portfolio Manager with IA Global Asset Management. Dan has over 20 years of investment experience and is the lead portfolio manager for the IA Clarington Strategic Funds, as well as the IA Tactical Income class. He specializes in equity income, high-yield corporate bonds, as well as investment-grade bonds. And we're really pleased to have Dan here today. And I think to kick things off, why don't we just start with your review of sort of the global economy and the markets.
Great. Well, thank you for having me, and thanks for everyone that's listening in. There's a lot going on, and if you sort of look back or step back a couple of years ago, you could have sort of seen this sort of unfold in certain ways, from too much debt and too much stimulus and all the spending that happened after the pandemic. But we're kind of through that now, and we're the way I look at it is we're kind of left with what we should expect over the next year or two. The global economy is okay. The U.S. is still exceptional from an economic perspective, and that's certainly going to drive the things that happen here in Canada with us. Europe is sluggish, but they're always kind of sluggish, and China certainly is trying to re-stimulate their economy. So there's some good and there's bad. But from our perspective, there's a lot of good. And if you look at, the things that move the stock market and the things that move the bond market and generally people's well-being from a financial perspective, it's going to come down to the economy. And, when you sort of break it down and you break down the most important aspects to us as Canadians and as investors, it's really going to be what happens in the US. And so one way, and I'll go into this just for a quick minute, one way to look at an economy is the same way you look at a household. So you look at the sort of the balance sheet, right? And the balance sheet of an economy is like a household. There's a lot of savings in the US. It's around 4 to 4.5% savings rate, which is pretty high. So there's a lot of assets on the table still there. You look at the income statement of the economy, which is generally, how is employment? And in the US, it's very strong. And of course, we're following in all of this because we have such a tight connection to what happens there. So, employment is strong, employment earnings and wages are strong. So the income side is good. And if you look at sort of, you step down to one more step in terms of where the risks are and in terms of loans and mortgages and people being stretched with debt. Those things are starting to improve for the first time in a couple of years. If you look at banks' balance sheets, they're telling us that loan delinquencies are getting better, and mortgage delinquencies are certainly getting a lot better, especially here in Canada. We've had a really big change from that risk perspective in the last year. So as we go through the bottom-up analysis of the economy, and those are the things that are going to drive our returns and our risks over the next year or two, the U.S. is in really good shape. And of course, as I've said a number of times, 78% of everything we do here in Canada is predicated upon what happens in the U.S. It's not going to be an all-in sort of moment. There's a lot of things going on, especially from a valuation perspective, especially from a debt perspective and a spending perspective. There are a lot of things going on, but if you just look out the next 12 months to 18 months as we do, as we allocate our clients' capital and try to get the best risk-adjusted returns for their investments, I think we're in pretty good shape. You have to sort of, ignore some of that noise and focus on some of the things that I've talked about. Those things are still in really good shape for the next 12 to 18 months. You might want to discuss a bit of, the impact of tariffs, right? Because that's in the news. And I'm sort of pre-guessing what you were about to ask, your next question, but I'm assuming that's what you wanted to ask. And that's in the news quite a bit. And, we should pay attention to this, but we should also sort of attack this bit of information in terms of our financial well-being the same way we've looked at the economy. And that's to put tariffs into perspective and then how that impacts Canadian investors. Now, to put it in perspective, we have to recognize the things I just talked about. 78% of our economy is predicated upon what happens in the US. The US is strong. Taxes going down, the income statement, balance sheet of the economy is strong, employment is strong, credit spreads are really low, tells us that there's really not a lot of risk that we can see out front. So they're probably going to do well. And then we've got this huge amount of something called operating leverage to that economy. It's just like a company. Like companies that have a lot of capital investments, a lot of buildings that need to be filled when times are good. They do really well when times are good. When times are bad, they still have the buildings, but they're empty. And that's why they have this huge swing in the good times and the bad times. The Canadian economy is very, very similar to that with respect to the US. We have a lot of operating leverage. When things go well there, our good times are exaggerated. And when things don't go well there, our bad times are exaggerated to the downside. So let's look at tariffs really, really quickly, just to put it in perspective. The average tariff in the US right now on everybody, and especially Canada as well, is around 3%, 4%. If all of the tariffs that are being spoken about are implemented, that'll go to about 8% on average total tariff rate. It's not enough to do a lot of damage to the economy. It's enough to sort of make things volatile. It's not enough to sort of upend economic growth. That's one thing. The next thing is the tariffs are probably going to be focused on steel, aluminum, and autos, and to somewhat energy. That doesn't mean that impacts your whole portfolio. And that doesn't mean that tariffs come in and every single sector that you can invest in or every single company that you can invest in is going to be negatively impacted. What it means is that you should probably be cautious on anything related to steel, aluminum, and autos until this sort of works its way through. Now, if you look at what happened in 2018 and 2017, this is a roadmap of what happens when there's tariff talk. And remember, there's always been tariffs. The conversation right now is increasing those tariffs. So if you look at the last time base tariffs became increased tariffs, was sort of 2018. And guess what happened to the Canadian economy? We actually had some of the best growth we've had in decades. We went from a 1% growth rate to 3%. The US, even though they cut taxes and stimulated and all the regulations that came down, they went from 2% to 3%. So we actually, from a percentage basis, we significantly outperformed them, even though those tariffs were somewhat pointed at us. And that's because of what I talked about, this operating leverage. So I'm going to make my last point on this. It doesn't mean there's going to be a lot of risk to our portfolios and to clients' investments. It does mean that you should reposition or rethink where you want to allocate clients' dollars or your own personal investments. Anything related to steel, aluminum, and energy to some respect, and autos, it's probably going to be in a bit of a volatile, time for the next 12 to 18 months. But the rest of the market, financials, industrials, telecoms, communication companies, REITs, staples, consumer staples, last time they did really well. And I expect the same sort of thing to repeat itself. Keep your eye on the economy and the underlying drivers of those things that I've talked about. And right now, they're still okay.
All right. The other question we seem to get a lot of is inflation. And sort of just wondering what your view is on inflation. And we've seen the Fed cut a few times, but we haven't really seen the longer term rates come down at all, actually. I'm just wondering how you view that.
Well, we followed and talked about inflation, quite a bit over the last 3 or 4 years since it really spiked up back in 2022. And what we said at the time as we analyze it is that it's going to be sticky. There's too much money out there. Globalization has declined since 2009. People think globalization, this importing of goods from everywhere around the world, just started to decline in the last several years. No, it's been on a steady decline since 2009. And why I'm saying that is because as globalization declines, you get a sort of predisposition of inflation to go up a bit, right? Because you're not getting the cheapest goods all the time from everywhere. So now you throw in all the money that was thrown into the pandemic, and we are still left with that hangover. There's still too much money. It's still too stimulative from an economic perspective to not expect prices to stay elevated. And we believe that. We've talked about every year we forecasted at the beginning of this year, even though everyone, including the Fed, said, inflation in the US is going to 2%, we said we can't see it being under 2.5. Now, you might not think 0.5% matters, but think about what you're reading in the news every day. The Fed's not going to cut rates. The Fed's going to cut rates. The markets go up. The markets go down based on whether they cut or not. And all of that is coming back to this inflation rate of being either higher than what expectations are of 2% or lower. And that's that short-term volatility. So the way we see inflation, and if you look at the numbers that came out today, which scared the markets completely, I looked at those numbers from every single subsector of the inflation data to see if my thesis has changed. Are we still heading towards 2.5? Not 2, like the Fed, but 2.5, which is still okay. And the parts of the inflation data that went up quite a bit were public transportation. Okay, that's kind of variable from people's pocketbooks. It gets too expensive, I don't fly. It gets cheaper, I fly. Cable and internet. The other big parts to the consumer's pocketbook, shelter, insurance, food, energy, they were all pretty tame or within expectations. So inflation expectations, let me just wrap it up by saying, you're going to hear a lot of talk about inflation's too strong and the Fed's rates are going to stay high, central bank's rates, and that's bad for the stock market. I don't think they're going to get much higher than 3%, and I think we are going to trend towards the end of the year lower. Remember, there's a couple of catalysts out there to push inflation down. They're probably a year and a half out to 2 years. That's AI. You may want to ask about that later on in this interview, but there are some things down the road that are likely going to help inflation. But right now, be focused on the actual change, and I do. It's going to be volatile, but I do think we're going to trend a bit lower as the year progresses, which will be good for financial markets.
Thanks a lot, Dan. Thanks for covering the topic on tariffs and anticipating our questions because we've been getting quite a number of calls on that topic. The other area of interest has been AI. A lot of clients, and it's on everybody's lips, and even the news on social media. Even if you weren't interested in AI, they seem to find you and make you interested. It could be one of those great disruptors in a good and bad way for industries. But Rob and Russ and I have been in this industry long enough, but we've seen a lot of fads too. We saw the .com crash where everybody needed to own .com companies. We saw the junior mining boom and bust in '07. Cannabis, the cannabis trade was everybody was going to be smoking pot all of a sudden. Everyone's going to be millionaires. And now AI, we see it as something that, again, every industry seems to be putting a lot of money into it. So I just wanted to maybe get your thoughts on, where you see this whole thing going and how it might even affect a couple of your positions. But with the view that I see just a ton of money being invested by companies, and to see a return on that investment is still kind of cloudy right now. So.
Yeah, and you know, we've seen all of these in my 25 years. We've seen all of these sort of fads, and I think what you can say is that some of them were fads in the short term and became impactful to sort of companies' earnings, which is important for us as investors as years went by. And I do think that's going to be the same situation that we find ourselves with AI. But you have to dissect it, right? You have to, and it goes back to what I was sort of saying about repositioning your portfolios. You have to dissect, you know, the amount of money that's going in, these hyperscalers, you know, Google and Microsoft and Amazon and the hundreds of billions they're putting into AI, expecting a payoff. That payoff, in my mind, is probably not going to be around for a few years, maybe 3 to 4 years before you actually start to see it, maybe 5. And maybe what you'll see in the next year or so is that, you know, the adaptation of it is somewhat limited in the short term, and some of these companies are going to be volatile because they're spending a lot of money and they might not get the full impact. Now, you also have to look at valuations, right? Like those parts of the market, especially, you know, the Magnificent Seven, these hyperscalers, the Googles of the world, the big techs of the world, the NVIDIAs of the world. The amount of forward revenue growth and adaptation expectation that is in the current stock prices is on levels that we've only seen 2 or 3 times in the last 40 years. And that should not keep you away from them, but keep you cautious on how this AI spending is going to make it into your investment future. I think a lot of the gains have been had. And I'll give you an example. You know, if you're paying for, you know, I'll keep the jargon light, but if you're paying, you know, 40 times for earnings and your growth rate goes from 50% to 30% to 15%. And by the way, technology is expected to grow around 15 or 16% within the next year and a half. Well, we as investors can get 70, 80% of the rest of the market for the same growth rate in the next year and a half without the same risk associated with, will people buy it? Won't people buy it? Will people adopt? Won't people adopt? You're sort of paying so much upfront for that expectation that it becomes very risky. But there are ways to sort of benefit from AI and the adaptation. I'll give you an example. So Wells Fargo, which is a position that we own for our clients, you know, in the last week, they've talked about the impact of AI. And this is where I think it's going to really help. Not so much in displacing jobs, but in creating efficiencies and higher productivity. And when that happens, margins go up. And when margins go up, earnings go up. And when earnings go up, stock prices go up. Even bond prices, if you're at corporate bonds instead of government bonds, go up. But I do think that that's 2 to 3, 4 years away. And I do think it's going to have a positive impact on a lot of companies. I would just be very, very cautious, and we are, on what are you paying for and how many years forward do you got to wait and be right to pay the right price today. That's when stock and financial investing gets really, really tricky, is when you hear a good story and we don't ask ourselves, when is the payback? And if the payback is in the next year or two, great. There's good confidence on that. If the payback is 5 or 6 or 7 years away, well, you might want to rethink how much exposure to have to those parts of the investable market. But I don't think it's a fad. I think productivity is going to go up. I think other companies are going to benefit from this. We're seeing it with Wells Fargo. We'll see it in the Canadian banks. You'll see it in industrials. You'll see it in companies, the telecommunications companies that have a lot of call center costs that maybe are being outsourced, that'll now come in and be more productive and lead to higher margins and profits. So there are some benefits. And you should reposition yourself for those benefits in the next year, but they're probably a few years out when you actually start to see it.
That's great. Thank you, Dan.
Rudy, yeah, you mentioned we've been in this business a long time and seen lots of ups and downs. I think the first one was Bre-X. This is way back, way back. But speaking of long time and 18-year look ahead, it's Rudy's birthday today. So happy birthday, Rudy. 44, and there's so much more. Because I'm senior investment advisor, I get a couple of questions. Dan, you mentioned savings rates in the US at 4.5. Let's focus a little bit on Canada. I know you're more of a global manager, but you've been in the business a long time. We have a higher unemployment rate, 6.5. We have 1 million mortgages coming due, which will be at higher rates. I know we're lowering rates now. Do you just a quick comment on maybe the impact that may have on Canada, and then I have another one after that.
Well, a year ago, I would have said the risk associated with interest rates and mortgage rates in Canada being so high were going to cause a pretty significant recession in Canada. And about a year and a half ago, I projected that by the middle of last year, the Canadian Central Bank is either going to have to decrease rates substantially to save the economy and to save mortgages, or they're going to let us go into a pretty hard recession because of the things you just talked about. The latest data, though, so they drop rates, and we know that. In June, they drop rates. But the latest data that's come from some of the CEOs at the banks that we've spoken to, and this number is approximate, but the number is about 60% of the shock mortgages that were waiting for us this year and next have been refinanced into much lower rates, believe it or not, which we expect that because they have to make a call, but 60% surprised even me a little bit. I thought it would have been about 30 or 40, it's 60. So the banks are actually now projecting that the mortgage rate, refinancing shock is going to be pretty much a non-event in the next couple of years. And given that mortgages are where they are, especially in Canada, you talk about our Canadian, economic problems. Employment isn't as good as it should be. It's a lot of part-time, not a lot of full-time. Inflation is pretty low here, which can be a good or a bad thing. Bad because, we're just not growing as well as we should be. Our growth rates have been stymied and our debt levels are too high, right? So you've got all of those things that were in front of us, but because the central bank acted like they did last year, and again, this is coming from some of the CEOs at our big six banks, about 60% of that shock has now disappeared. So I don't think I believe them. I don't think it's as much of a risk going forward from a mortgage perspective, but we do have risks. I mean, we can't ignore the fact that we're just not growing. We can't ignore the fact that our debt levels are the highest they've been since the 90s, early 90s. We just can't ignore those things that are going to stop spending in Canada. So we've got to rely on the US to do well. And again, be careful. If they get into trouble in the next couple of years and we don't clean up on our side, our downside will be exasperated. And you've got to be active around that risk.
You mentioned the US savings rate of 4.5. Any idea what Canada's at?
Yeah, I think it's probably under 2 or around 2.
Okay.
Maybe between 2 to 2.5.
Commercial real estate, any comment? That's been seems to be a concern. Everyone seems to work from home and as a major concern. Anything that you're hearing, big cities?
It's a big, I haven't heard that it's getting any worse in Canada. If you look at Brookfield's sort of commercial property part of their balance sheet, like it's getting better. You look at their share price. I mean, it's gone straight up in the last year. And that'll tell you that their expectations around commercial real estate and the real estate part of their portfolio is getting a lot better, a lot stronger. In the US, is it a systemic risk? No, because the majority of commercial lending is in the regional banks. It's not in the big money centers, the JP Morgans, the Bank of Americas, the Wells Fargos. It's not there. It's in these smaller regional banks. And so you don't have, I don't think, you don't have a big systemic risk in the US. And in Canada, with interest rates the way they are, we're just not seeing the big delinquencies on the loan side that could have been expected a couple of years ago.
Excellent. Last question for me, and then I'll turn it back over to Rudy. And again, thanks, Dan. It's been an absolute pleasure. We've mentioned a couple of times we've been in the business a long time. I find moments like this extremely exciting. I've had more calls about the tariffs. I think it's Donald Trump that sets people off than I did during the great financial crisis, than I did during COVID. People were texting me over the weekend. But maybe on a positive note, and I just don't, when I look at investment advisors today, the amount of inheritance that's come across our desks, house prices, if someone sells in Shaughnessy or in Toronto, and they're inheriting way more money than clients did 30, 40 years ago. Just a brief comment on that.
Well, there's a couple of things I think. It's clear that there is going to be a tremendous wealth transfer. And if you're talking 1.2 trillion that's going to be transferred in the next 8 years or 10 years or less, our economy is only 2 trillion. So that's more than half of our total economy in a year that's just going to be transferred. And the other part of it is it's going to hopefully be more productive dollars, right? Like, at some point, when I pass on any wealth to my kids, like I'm sitting on it right now in a house and whatever else we're doing with it. And at some point it's going to be passed to the kids and the kids are going to spend it. And then that's going to drive, believe it or not, that's your upside to the Canadian economy. That's going to drive spending, and it's going to drive different parts of the market that you're going to have to require to deal with, not only just allocating your capital for your family and your children, but you're also going to have to deal with the taxes around that, the disposition of real estate. And I'm not just saying this because I'm on a call with you as my partner. Even for me, that I think I know what's going on, we are actively engaged with an advisor right now because there's going to be a lot of change in the next 10 to 15 years. And there's going to be things that you're going to need some expert advice on. So I want to put that into perspective. 1.2 trillion on a $2 trillion economy, if you just spend 7% of it, you're talking the size of the whole transportation economy in Canada as extra GDP. Or an extra GDP stimulant coming into the economy. That's going to have ramifications around real estate, ramifications around tax planning, ramifications around where you should be invested. Should you stay in Canada? Should you avoid energy? Should you get more global? Like, there's so many things that are going to be impacted if you want to stay ahead of your living costs and just getting a proper risk-adjusted return on your assets. So I think it's a big deal. And the US is in the same boat. So is that the silver lining for us? A lot of debt and employment's not very good. Is that the silver lining? It might be. That might be the margin of safety as we sort of clean up our policies, our economic policies. And if we can do both together, well, you might want to consider getting more money back into the TSX. TSX is trading at an 8-time multiple cheaper than the US market. And if you believe any of this stuff that I'm talking about, you want to buy low and sell high. And again, repositioning your portfolios for this sort of eventuality is going to be important.
I have a question. You invest both in stocks and bonds, and just wondering how you're kind of viewing sort of the risk reward relationship between bonds and equities right now.
So it's getting, if you look at corporate debt, which is what we're predominantly invested in our portfolios. So we're basically buying the bonds of companies. We're not buying government bonds as much. We're not buying interest rate sensitive bonds. We're basically saying, if we can find a good company and a good bond and invest in it, we're sort of being consistent with how we invest in stocks, but just with a lot more safety. Now, having said that, it's going to be tough for the equity market going forward to compete with where bond yields are. For example, a pretty good higher yielding corporate bond right now is, yielding 7 to 7.5% for 5 years. So you're getting that return, assuming the company doesn't default or go away, you're getting that 7% over the course of 5 years, guaranteed, assuming no default. Now, take, for example, comparing that to stocks, and we deal with this question every day because we have total flexibility. Where do we put that loonie in the air? Where is the best risk-adjusted option for our clients? And right now, when we look at stocks, although I've said you've got to reposition and be careful, but the market in general is pretty expensive. In fact, the US market, now we're cheaper here, but the US market, at these current valuation levels, historically looking forward to 10 years, your expected returns are between -2% and +2% over 10 years. That may or may not hold, but it's a blueprint of what happens when you buy things very expensive. Now look at bonds. If I can deliver a 7.5% corporate bond return for the next 5 years with a lot less risk and a lot less volatility, and now it's becoming, you've got some competition for the stock market. And even for investment grade bonds, like government bonds, for the first time in 20 years, has the yield on a 10-year government bond in the US been higher than the earnings yield of the stock market, which is basically just saying you sort of inverse the price of stocks in terms of what you get in yield, so you can compare the two apples to apples. For the first time in 20 years, bond yields are higher than stock earnings yields. What that tells you is that if I'm risk averse or if I'm risk adjusted return, I've got a lot more competition now to put more of my dollars into the general stock market than I do taking the 7% corporate bond yield on the bond side with a lot less risk and a lot less volatility. And so you'll see our portfolios as an example. Last point on this, so you could see this opinion being worked real time. In the last year and a half, I've been talking about this. Our bond exposure in our balance fund, our Go Anywhere, Do Anything balance fund, has almost never been more than 30% in 25 years that I've been managing money. It's at 40 right now. And 3 years ago, it would have been 24%. So we are going through this exercise over and over again. So it's important to see your options in totality and consider the risk and what you think the expected return is. I'm not saying stocks are going to do -2 in the next 10 years. I'm just saying that the data says for the last 60 years, if you buy them at these levels for the next 10 years, you're probably up 2 to 2.5%. And so that risk-adjusted equation becomes a lot more tilted towards bonds right now.
Dan, thank you so much for the time. I find it's very easy to listen to you, and you've always been one person with very strong convictions on your thoughts about investing in markets, and the way you explain it makes it very clear for our clients. I really enjoyed having you as our first portfolio manager on the call to help explain a lot of the noise out there for our clients. Rob had mentioned to you that today is my birthday, so I was just thinking about other people that I share a birthday with, and the few famous historical figures. One is Charles Darwin, the noted naturalist, and his great groundbreaking work on diversity in life. But I think we can extract a lot of that into what we do, which is obviously diversity in your portfolio, but diversity in ideas. And listening to people like you really allow us to bring new ideas and always recreating and redeveloping our own ideas. So the diversity in the relationships and ideas that you have in life is critical for the ascent of not just our species, but in our profession as well. So thank you. The other one is Abraham Lincoln, one of the great statesmen of America. And He said once that if it's going to take me 6 hours, if I've been given 6 hours to chop down a tree, I'll spend the first 4 hours sharpening my axe. And I think that's what a lot of the work we do with advisors is that we have people like you, Dan, to help sharpen our axe and continuously allow us to do a better job. And as the years go by, I think we can confidently say that I think Russ, Robin, and myself, we feel we're doing a better job every year just by learning. So, and last but not least, the great novelist Judy Blume. She was instrumental for our generation, anyways, to learn as we got through their teenage years. I know for Rob, I'll speak on behalf of Rob, it got him through adolescence and allowed him to become the man that he is today. So thank you, Judy Blume. Last thought, with all the stuff going on, and this is what I learned in business school, we were always told about globalization. That's the key to the future. And we've seen a lot of changes over the last couple of decades where, and Rob said it best, focus on your own economy. Don't worry so much about some things you can't control, but the way you save your money, the way you spend your money, spend it in the local shopkeepers, control the way you manage your money. And with our help, we can assist with that. But also, IA Financial, a lot of you aren't aware of it. We're a proudly Canadian investment firm. The company was established in 1892, 133 years ago. It's always been Canadian, and we've always helped thousands of Canadian investors with their financial futures. So if we focus on our mindset, which is our mantra, you don't worry about the markets, worry about what you do. And a good start is focusing on your own economy. So having said that, thank you very much, everyone, for joining us on our Look Ahead call. Thank you, Dan, for those fantastic insights. And we'll catch you next time on our next call.
Great. Thank you. Thanks, everyone.